What's up, everybody? Welcome to Solana Weekly. This is your host, Thomas, and I want to thank you for joining in. Let's take a dive into the latest trends, use cases, and people behind the incredible growth of the Solana ecosystem. None of this is financial advice, but I'm hoping that all of this is alpha. Now let's get to the show. We are joined today by Marcin from Redstone, they're bringing an oracle that is specific to RWAs on Solana. So I really want to hear all about this. Welcome to the show, Marcin. How you doing?
Hi everyone. Hi Thomas. Thanks for having me. And yeah, excited about chat everything RWA and Solana.
Yeah, and I guess a warm welcome to Solana, right? You guys just launched on Solana the end of last month, is that correct?
Yeah, I mean, the technical implementation was actually ready a bit earlier, but we also
Uh-huh.
wanted to make sure the RWA partners are lined up with us. Those institutional deals and timelines are usually a bit longer than the DeFi
Definitely.
ones, but we wanted to make sure that on our end everything is ready when the big day came.
Yeah, I can only imagine how much would actually like go into verifying everything beforehand before you launch something like that, right? Like the amount of testing was probably insane.
Yeah, but it's also fun.
Yeah, of course. So now that you launch, like when you guys launch, was there a lot of products right out of the gate, or how exactly does that look? And you can start wherever you want. If you want to, start talking about the protocol and how you guys started it, that's fine. Or just kind of start talking about the launch. I'm fine with that too.
Yeah, so we are probably not so well known in the Solana ecosystem, so happy to give 2 cents how we came around and why we launched on Solana now, like we launched recently. So
Hmm.
myself, I'm co-founder at Redstone, responsible for everything related to go-to-market, making coffee, going to conferences, essentially making sure the business is running.
Uh,
I've been in crypto since late 2017, wrote my bachelor thesis back in the days about blockchain, Ethereum, Bitcoin, and early networks back in the days, consensus mechanisms. At that
yep.
time, that was a pretty hot topic, right? It was when Ethereum was still running on the proof of work consensus, right? Um, then I was working at a couple of startups. Google Cloud as well. And 2020, together with Jakub Wojciechowski, who's the technical founder of Redstone, we kicked off the Oracle um, infrastructure. The reason for that was we identified that Chainlink model, though it was handy for the developers, it was pretty hard to scale to plenty of networks and plenty of assets. So from the day one, we wanted to create something that is inherently more scalable. Therefore, we went for modular architecture. So we defined 4 modules in the design to make the integration of a new chain or a new asset way more lightweight. And 3 out of 4 modules that we have are kept off-chain to diminish the amount of work needed to, again, launch on a new virtual machine or new environment in general. And historically, we've been mainly expanding in EVM ecosystems. So, Ethereum, Avalanche, Arbitrum, Hyper EVM, many of those. We were the first Oracle to launch on Ton by Telegram. We launched on Starknet very early, Fuel VM, and other uh, alternative VMs. And with Solana, we were connected with the foundation only in 2024, I believe. And our approach to expanding to new networks was always, hey, we want to go where people want us. We don't want to go somewhere like where we just want to force to be needed. It's more like, hey, when we see an opportunity where we can bring tangible value and then make a proper like value proposition for the audience and for the developers, that's the moment we want to go somewhere, right?
Yeah.
And when we closed the deal with Securitize as becoming the primary and official Oracle partner for BlackRock Biddle, Apollo Acred, Vanik Vibil, and other tokenized funds. It turned out that Solana is also growing with real world assets and tokenized products. And that was the perfect moment to do that. And I met Lily, president or director of Solana Foundation.
Oh, yeah.
Uh,
She's great, right?
Yeah, she's awesome. She's fantastic. And I met her at Binance Blockchain Week in Dubai last
Okay.
Q4 last year. And ever then we started chatting about expanding to Solana and enabling like RWA and DeFi implementations that came into existence, a couple of weeks ago. So glad it also made it happen. And as for the Solana launch, for starters, we needed to implement the connector for Solana virtual machine, making sure that the data feeds that we as an Oracle deliver to Solana are reliable, up to date, and also that we can deliver not only crypto but other types of data, like in example, tokenized funds, and ensure that the protocols that are on Solana, in example, Camino, Drift, potentially Jupyter, Safe, and so on, would also be comfortable integrating the Oracle and the interface that we delivered. So all of that was a very interesting and educating exercise. So we're interacting with DevNet, TestNet, Mainnet, many different protocols out there. So our engineers had a lot of fun building that stuff.
Yeah, yeah, I bet. And that's the way to do it too, right? Like you need to be integrated in all of the biggest DeFi platforms because that's where people are really going to see a lot of the value in these RWAs being on chain, right? Like I guess I mean, you just went over a lot. And I should probably talk about some more of that. But I mean, when I think of RWAs and like as somebody that's more native to crypto, I'm excited to see, okay, what can we do with these RWAs now that they're on chain, right? Like I'm excited to see like, okay, there's going to be DeFi protocols where people are actually going to be able to lend off things that they couldn't really do before, open up new use cases. So I'm excited to see that. And, it seems like you guys had pretty good foresight early on that you built everything out to be multi-chain. So was that something like a core part of, kind of like your thinking about how everything was going to go? Because it seemed to be turned out true, and it seems like that's, it's especially for somebody that's providing an oracle on various chains, you need to be able to do that. So to set it up originally like that seems like a pretty good choice.
Yeah, so as mentioned from day one, we wanted to make Redstone available on thousands of blockchains because we do believe there are going to be plenty of those networks, both public, private. Yeah, we see, I believe, a reincarnation of some of those private instances with, for example, Kinexys by JP Morgan and some other bigger institutions we chat with right now. All of them are going to require, very accurate data feeds. And this is what we
Yeah.
want to be an essential part for DeFi lending, borrowing, CDP, and any other type of DeFi activity that would rely on the price feeds themselves. And as you well mentioned, like Solana itself, we could probably have launched earlier on the chain, but as mentioned, we really wanted to omit the situation where we just say, hey, we are present and everyone is like, okay, but why? I mean, like, what's the
Yeah.
value proposition? Like, why would I, essentially cooperate with you guys? We just wanted to be there when there is an actual need and actual use case that we can unlock. And this is what we've been doing right now, past couple of months already, and what we want to do going forward, right? You have a ton of ideas how to make the process even more efficient, new tokenized products that can go to the on-chain environment because right now we have two major ones by security types. One is the tokenized T-bills, so treasury bills from the United States, which
Yep.
is fairly simple, I would say. And then we have tokenized private credit, which is more sophisticated and also has more various flavors. So what kind of credit it is, what is going to be the risk, because you can have riskier private credit and then it would probably yield higher return, but there's a higher chances of things going south and people defaulting on some of those loans. And then you also have to take it into account when you're pricing those kind of collaterals.
Yep. Now, I'm not like an expert in private credit. Can you talk to exactly what that is? So are you I don't even know where to start on that.
Yeah, very happy to. Again, my background is not like at the TradFi desk. It's way more in the technology and economics. So I graduated quantitative methods in economics.
Uh-huh.
So I know how government monetary and fiscal policies work, and on paper at least, how the trading desk at JP Morgan should look like. But I was never
Yeah.
a banker myself. I used to work at
Yeah.
Google Cloud. That was, let's say, more on the tech side. Though
Yeah.
I've been learning the TradFi word for the past 4 years because majority of the DeFi components are the TradFi well-known concepts just brought on chain, right? So borrow land, in example, it's not a concept that came to existence in the on-chain rails. It's been a very well-known concept in the TradFi ecosystem. So private
Yeah.
credit is all about enabling people and institutions to borrow and lend money to each other outside of the traditional banking system. So you can imagine an entrepreneur that has, let's call it, 5 factories in the United States, and that entrepreneur would like to create a railway or some other connectivity system between them to increase the efficiency of those factories, or maybe introduce new products, right? Because one factory produce a component that the other factory could use and create a new product, and this connectivity is missing right now. They could go to a regular bank, again, let's call it JP Morgan, Goldman Sachs, or Citi, or any other big player, and such a bank could either, for example, deem it too risky, not being able to assess risk properly. Like there are plenty of rejections in these kind of cases just because the desk at the traditional finance institution is unable to properly give like an assessment or what rate should be accredited to that kind of a case. Or there is a happy path and then they just get a loan in a bank and then that's done. But many of those such cases, they do not get it at the bank, so they need to look for an alternative. And an example, Apollo, which is a behemoth in financial world with right now $750 billion asset under management, is facilitating credit. So what they would do, they would find people who want to lend money to, let's call it Apollo as the intermediary for, in example, let's call it 8% yield on it. And then on the other side, you have this entrepreneur that has this railway to be built and needs, let's call it $10 million to deliver that project and is willing to borrow it for, let's call it 12%. And then the difference can be what Apollo would be doing in this whole like interaction with one and the other party, and Apollo is making sure that the contract is well structured, that it has the best interest of both, right? Like because they don't want the borrower to default, neither the lender to lose trust, right? So they're also acting, making sure like supervising the delivery of the railway because it can be, for example, 3-year project. So they would regularly send a person to check how the work is going, and if there's any problem on the way, there might be some clauses to do. So this is like a pretty regular borrowing contract. And then you would acknowledge that there is this lender, and this lender usually in traditional finance would have to have a lot of money. So it's not that you have a random person in New York on the street on the pavement and that person can give $100 to Apollo. It's
Yep.
rather like a big financial institution. Again, it could be even this first bank that rejected the project
Yeah.
that has some basket of more higher risk
Yeah.
exposure that would give money to Apollo in the end
Yeah.
to
Yeah.
run this whole assessment of the rates and then managing the transaction itself, right? So those lends are usually millions of dollars. I would say probably the average minimum would be 5 million or maybe even 10 million, which
Mhm.
makes it very inaccessible for regular entrepreneurs or even small businesses, right, to lend money in that way. And
Yeah.
via tokenizing the fund, you can diminish the allocation over there. So, for example, for Acret from Securitize, the minimal investment is $50,000. So, to contrast it with, for example, $5 million, there's like a big gap, and it makes it simply way more accessible for anyone to join. So,
Yeah.
private credit.
It's 100x difference, right? That's a pretty significant difference when you're looking at that, right?
Yes, exactly. And then the private credit fund would be stacking up many of such like transactions that I explained on the railway sense. Let's call it 100 of similar transactions and making it like a product. And then on one side, just sell it as, the yield generating product with some risk to it, right? Because it's not like as risk free as T-bills, because T-bills are necessarily deemed risk free, especially the short term, like 0 to 3 months on your balance sheet are even accounted as cash, right? Like
Yeah.
in accounting principles, you just don't distinguish cash from, let's say, the 0 to 3 month T-bills. And here there is a risk of default, right? There is a risk that a hurricane comes and destroys 3 of the 5 factories, and it turns out that you don't need the railway altogether after one year, for example, of the development, and then you need to understand like what to do, right? Should the borrower give back, let's call it 50% that is left from the project back, and then there's repayment. So there are those, hey, unhappy path cases, let's say, that to be
Yeah.
resolved. But if you package, for example, 100 or even better, 1,000 of those loans, then even if one or two of them are going to default, the yield that the others are going to generate is going to cover up, for example, the losses, right? So it's very
Yeah.
important for Apollo when they are structuring that fund to make sure that those loans are diversified. So there is no like a domino effect that if one defaults, then another defaults, then another defaults, because then you might have like a collapse of a specific product.
Yeah. That makes sense. That makes sense. So with the way that they're building these, like how much of that are they actually doing on chain now, right? So is that whole process like facilitated through you guys, or is that like that's how is that even done?
Yeah, that's a really good question. And the answer is not much is happening on chain yet. It's
Yeah.
a baby steps process. So right now what's happening is the process about private credit I explained has been going on since forever, like, probably hundreds of years even.
Yeah.
And Apollo has a well-functioning credit fund in traditional world. And what they did with Securitize is they tokenized access to that fund so that you can get this exposure on chain. So you can get access to ACRET on chain with securitized tokenization. And what we do in the whole spectrum is that the moment, imagine you have one share of this fund and it's tokenized. So you have one share of the fund somewhere in the custody of Securitize, let's call it. And
Hmm.
then you have on-chain representation of that fund on-chain. The value of this one share is fluctuating. It's changing over time. So Securitize is not delivering info about the dollar value of this one share. They just tokenized that share. And Redstone is doing, we are gathering info about this value and bring it on chain so that you can use this tokenized share and implement into the DeFi applications such as Camino, Drift, Jupiter, and so on and so forth. And here, a very important caveat is that ACRET is a tokenized fund by Apollo and Securitize, and it's a security. And
Yeah.
this security is impossible to use in DeFi currently. Therefore, Securitize came with a very interesting concept of S-ACRET, which is a sort of a representation. I actually don't know what's the best word. That would be the
Is it
question to
like a
Securitize.
almost like a liquid staking token or something?
The difference is liquid staking token is usually yield bearing or
Yeah. Yeah.
rebasing. So there is a
Yeah.
yield component to it. Here, the yield is not accruing in any sort. It's more like to ensure that the vault that is holding ACRET, that is a security, can issue S ACRET, which is not a security anymore, so that it can be used in DeFi. And
Okay.
why is it important? Because a security you cannot liquidate, because to liquidate a position you have to take it from one address and give it to another address, and securities are non-transferable, right? Like should not be at least transferable. Therefore, you create this S-ACRET, which then is being able to be liquidated. So if S-ACRET position is underwater, a liquidator could catch, let's say, that position, close it, get S-Acred, go back to the S-Acred vault, and get back the USDC straight from S-Acred. So the liquidator wouldn't interact with Acred at all. They would just get the swap of S-Acred to USDC. So this innovation that Securitize brought to the market. In my opinion, is a very elegant solution. They are going to innovate even further with that. That's like the first version, but this already allows for those secure like tokenized assets to be used across DeFi.
That's pretty interesting. So it almost seems like what you guys are basically able to facilitate is like a lot more of like what traditional finance is doing, and you're able to bring that on chain and have it be a better way, right? I would imagine holding any of those assets like as when it's tokenized, you're able to see more, you're able to get more information from it, right? Than just holding it in the traditional way. Is that right?
Yeah, so there are a couple of benefits actually, and to name those that are on top of my head right now, one would be a smaller investment that is needed via this person to get exposure to Acred. As I mentioned before, as you confirmed, it's like, for example, 100x smaller investment that is needed.
Yeah.
Second thing is you can loop the product. So essentially, you're creating sort of like a structured product because in regular Word, you would just take Acred. Acred is already the securitized fund. The name, give me a second, it's called ADCF. Diversified Credit Fund by Apollo Diversified Credit Fund. This is the name of the product in TradFi. So this product lives in TradFi and has nothing to do with blockchain. And
Yeah.
this product is tokenized with Securitize, and then it's named ACRED, right? So this is the tokenized version. So if you're holding the non-tokenized version, you can just hold it. I mean, probably technically you could facilitate like further exposure with that as a collateral in TradFi, but that would be difficult and very fragmented. There is no like structured way to do that.
Yeah.
And what Camino and Drift Institutional offers right now is, hey, if you want to increase your exposure to Acred, you can just loop as Acred. And how looping works is you get S Acred. Imagine there's $1 million position you're creating in S Acred. Then you go to Camino or Drift. You put it as a collateral. So we have $1 million value of S Acred as collateral on one of those platforms, and you would borrow USDC or USDT against it. Uh, LTV, loan to value, for simplicity, like the liquidation threshold would be, let's call it 70%. So you would borrow only 50% to be on the safe side. So you would borrow $500,000 of USDC. And then what you're doing, you go back to Securitize. You again get S Acred. So now you have 500,000 S Acred. And again, you go to Camino or Drift and you loop and loop and loop until you're, out of $50,000 is the minimum you can invest with as Acred. So until the moment you're, lower than that, it just doesn't make sense. And it is not without risk. Everyone has to remember that in DeFi, you always have the platform risk. So if Drift or Camino gets any hiccup, that's your exposure. But there is also a risk of Acred going down in price. So, for example, T-bill, tokenized T-bill, in principle, should always appreciate in value. So if you look on the chart, it's going to be up and up and up. And the moment it starts going down, we have a problem because then the global reserve asset, which is American T-bill, has a problem, right? So by principle, it should go up always. But with tokenized credit, there can be a chance that, for example, a couple of those loans defaulted. And imagine yesterday, one SA credit was worth for the purpose of this demonstration $1,000, and today it's worth 995, right? So $5 it dropped in value. So if you put your looping strategy very, very close to the liquidation threshold, it might turn out that all your positions of looped were liquidated, and then you
Yeah.
lose a very large chunk of your position to that. So everything comes with a risk.
Yeah, yeah, it sure does. And the more crypto version of this that I see, like as the best example of this, is Jupiter's JLP token. Everybody has it. Everybody loops it. It's a fantastic product when the market's going up, but like in any sort of dip, like you do run a liquidation risk. And one of my new favorite protocols is loop scale. So I mean, you go in there and you can loop 10 times. You just press a button and you're highly leveraged on those. But it's definitely a very probably I don't know. I mean, it's a very used part of DeFi in all of crypto, right? I feel like a lot of positions just get extremely looped, and it's a way to get mostly more exposure, more yield, and you can get pretty degenerate on it if you decide to.
Yeah, that's correct. But to me, look, I've been interacting with DeFi for 5 years now,
Yeah,
and there's always the other side of the coin. For every loop, there has to be the other counterparty that is supplying stable coins, or let's say the other asset that is available for looping, let's call it.
yeah,
And there is a reason that party is doing so, right? So that reason can be, for example, incentivized via some native token over the platform. So not only you get yield, but you would also get, an example, like future airdrop for that. Or maybe it's just a yield, let's call it 4%.
yeah,
And how I read it, and as I talk with investors and degens in general, looping is not without risk, and the exposure to stablecoins is also appreciated. So I wouldn't say looping is the ultimate strategy that everyone should just do as much as
yeah,
possible and put the
yeah,
whole
yeah,
bag. Of course, there should be a diversified portfolio out there. Not a financial advice, by the way,
yeah,
right?
yeah,
But I do agree, looping is very, very interesting, and I find it that in TradFi, there's at least I'm not aware of a one-to-one product that would be like this, right? Like because in TradFi there is leverage on positions, but probably not like looping, for example, six times the same
yeah.
and over of a position.
Yeah, yeah, and it's funny, I say like degen as far as a lot of the lending and a lot of what's going on in crypto, but the TradFi gets pretty degenerate as well. Like there is a lot of leverage in a lot of the TradFi systems as well. So I would imagine that you're probably exposed to a lot of that too, right?
I mean, personally, I'm not exposed
Oh,
as,
personally, yeah,
as a
but
per.
you see a lot of it. Yeah, but I mean, you see a lot of it. That's what yeah.
Yes, I do see a lot of it, and so since the beginning of the year and Trump being, in the White House, we've seen a lot of really interesting projects being brought to the market. And
Yeah,
by brought to the market, I mean kicked off. The big institutions and organization to actually implement a product that is related with blockchain needs 1 to 5 years, depending on the complexity of the product and the organization, because then you have to move legal, marketing, development, and all the other sectors out there. And the more I chat with people, the more I realize that throughout 2019 or even earlier to 2024, there were plenty of good products or ideas in those big organizations that were put on the shelf for the better days or for the days that would allow for those to be implemented. And right now, people blow on those things, like the book on the shelf, and they are like,
yeah.
okay,
Blow the
let's
dust
try
off.
blow the dust off, and then they are like, okay, let's implement and rock and roll with that. So I'm very happy to see it, though. Um, and this is my personal take. I'm fairly convinced that we are going to see some failures
Oh yeah,
because some people are just too optimistic. Like they feel like, okay, in DeFi nothing can go wrong, and we've seen many things in the past years to go wrong. So there is going to be a moment of overheating. But thankfully, I believe the transparent nature of DeFi and many people like just looking at the ledger, looking at the looping, looking at the risk, will be able to identify it early enough for that not to grow to systematic risk for the ecosystem.
Yeah.
Though I would say right now a potential systematic risk for the ecosystem would be staking. Like if there would be systematic bug or a hack or anything bad happening with staking or even liquid staking, then it could be truly, truly problematic for the crypto industry.
Yeah, I personally have quite a lot of liquid staking tokens of Solana that are looped right now. So I would hope that nothing like that would happen. But those are some of the most like heavily audited smart contracts in all of Solana. I think the Solana Foundation or Solana Labs actually released the first one, and I know Infinity has been looked at really well. So I feel pretty safe with them. But yeah, I mean that would be a pretty systemic risk right there. And another thing that kind of where my mind went when you're talking about how all of DeFi, there is a lot of not risk, but I mean it does get it's especially on Solana, like it's more recent. Like a lot, like the DeFi surge in Solana is probably more of like a year or maybe 2 years old. Like back like a couple of years ago, once FTX left, like there was no money. Like there wasn't that much money in DeFi. It really came back pretty recently. So I mean, I've been excited about it. I think that it's awesome, and we're seeing a lot more people come into it. We're seeing TradFi utilizing it more. But what really blew up a lot of the lending in the last cycle was the centralized lenders, right? It wasn't DeFi. All of DeFi, and that was primarily ETH and L2s where the DeFi was, but all of those protocols were fine, right? It was the centralized lenders, the BlockFis, the FTXs, Voyager. It's like all of these centralized exchanges that were doing a bunch of lending that couldn't be audited, that wasn't audited, that wasn't backed. Like they were just doing wild loans, right? Like those were the ones that ultimately probably like popped the bubble of the last cycle pretty much, right?
Yeah, and that's what I was talking about, the, let's say, more public ledger, because no one
Yeah.
was fully aware what's cooking in there, right? And I believe
Yeah.
that was a very similar situation to 2007, 2008, financial crisis, that
Yeah.
even people within the organization probably were not fully aware what's happening in there until it blew up and it was too late.
Yeah. Yeah. Yeah, my mind now goes to it was like the Three Arrows Capital. They were like lending a bunch of money, and I think there was like a handwritten note that one of them gave saying that they had a couple $1 billion under management, and you look back and they just had nothing, right? It was just a crazy crazy glass house that they were in.
Well, hopefully it's not going to repeat, and I do hope that these kind of lessons make the ecosystem stronger and stronger and more
Yeah.
cautious for things that are just too good to be true, right?
Yeah, yeah, definitely. And one thing that you did mention, did you mention that there was a like an institutional side to Camino and Drift? Did you mention is that what you said? Is it's they're not just trading on the normal version of Camino or Drift, right? This is something separate.
I think on Camino it's just a regular pool, so
Oh, is
there
that
is no like anything fancy over there. Drift created like Drift Institutional, which is like a kind of like a segregated pool specifically for institutional products. To what I know, at least, they plan to launch some more going forward. So it's a more structured initiative rather than just like, one of, hey, we launch S Acre and that then it's done.
yeah, yeah, okay. Yeah, that sounds good. Oh, that's exciting. So it's like when I think of RWAs, I'm excited for there to be more assets that people want to hold on chain. Like what else are you seeing that TradFi like there is just like a big surge in RWAs, right? Like there a lot of different things are coming on chain. Like what are people wanting that aren't like crypto native when they're bringing assets on chain? Like what are they seeing? Like what are the benefits to them that they're seeing?
Yeah, that's a really good question, and we've been delving into that deeply over past weeks and even months.
Hmm.
I'm not sure when this podcast is going to be released, but Let me tell you, around end of June, we're planning to also release a pretty beefy material about RWA and the oversight of the market at large. So what
Mhm.
people are actually doing over there and what it means for the future. So once it's going to be published, I definitely recommend like having a look and understanding what we bring to the table over there. But specifically on tokenization and RWA from those TradFi guys, what they like is broader access. So people who couldn't get exposure in TradFi can do it in on-chain rails. So even myself, I'm located in Poland, in Warsaw, and if I wanted to get exposure to private credit fund in New York City, an example, I'm not certain what would be the steps. Probably I would have to set up American bank account. Then I would have to maybe even in person fly over there to sign some documents. I'm not certain. Maybe it's not that bad, but I would assume it's not like super straightforward. And in this crypto rails, the process is way easier and digitalized. So I signed up into the securitized platform. In order to get exposure to ACRET, you need to be at least accredited investor. So it's not that it's for everyone, at least right now. Um, I do believe these platforms will work on more and more accessible, um, you know, environment for these assets, but it's also has to be to it has to be done alongside the regulators because no one wants to do anything that is against the law and against the rules that are present on the market. And as I started this podcast, I will say it again. RWA and institutions are or about step by step, like baby steps, making sure things work, and then we take another chunk and another chunk, because the crypto boys, let's call them, are probably used to, okay, it works, so let's put 10x fire into that and see if it's going to hold and be the next unicorn or it's going to blow up, and then we have a problem, right? So it's a very
Yeah.
different mentality than trading meme coins or 10x leverage on perp market on
Yeah.
Jupiter Drift or anywhere else. And these platforms, like these big institutions, they also have to grow confidence and understanding of the on-chain environment, because right now they understand, let's call it custody, they understand tokenization, they understand potentially like simple looping, but talking about more complicated like MEV, more complicated terms like MEV, cascading liquidations and what is the impact of that, especially when there is like on-chain and off-chain world. What are the risks involved? What assets should be paired with a specific tokenized asset for correlation or not so much correlation of the yield or the risk associated. Those are all things that have to be like, ironed out as we go and as we learn more and more. Um, so broader accessibility is one that they mentioned. Another one that they really like is secondary potential, at least for secondary liquidity. So as mentioned, ACRED is a security, so there is no DEX pool where you can trade it. But as I understand it correctly, for S ACRED, so this, let's call it representation version, there potentially could be also a pool. So people could potentially like, swap it, trade it, and make secondary liquidity. So there is also a quicker exit scheme. So you can either go to, let's say, securitize and redeem and wait, let's call it 90 days, or you can swap it on a pool potentially with, I don't know, a percentage or 2% discount, right, in the pool, because you just want the liquidity to be instant. So those are also a very interesting concepts that in TradFi markets on structured products, it's usually impossible to implement because of the infrastructure and many other aspects out there. And last but not least, what they really appreciate is this composability of DeFi. So they see the tokenization and looping as the first steps, but as they go further, they are already interested in potentially creating an on-chain hedge fund or bringing some other interesting products from TradFi market on chain. So as mentioned, I believe it's going to be like a gradual expansion of these kind of products.
Oh, that's awesome. Oh, that's so awesome. Yeah, we always I always think that crypto adoption is people coming on and, buying NFTs and buying meme coins and, using what we use, but it's completely different, right? It's people are going to come and use what they know and, the tokenized version, especially if they're able to get liquidity in, a 1 second swap versus 90 days, like that is going to be incredibly useful for them. That's exciting. That's very exciting.
My, my personal take is the products that are going to bring mm, billions of users, even to crypto, are going to be some sorts of yield-bearing stablecoins.
Yeah.
If we are going to be able to create products on chain that are easily accessible for the masses and will be on stablecoins that give more attractive yield than regular products and have relatively low risk profile. So, an example, let's call it looped Etina. um, is it high risk or low risk? That's a more like a deeper question, but for sure it has sustained couple of liquidity crunches and volatility on the market. So if you can create a structured product that is uh, exposure to a looped position for ETH SUSDE, and then for the final consumer, just see like, hey, put in stablecoin and you get X yield and you accept the risk, and as long as you're not going to overheat the system, so put too much leverage, or you should probably impose some caps, right? Because Ethereum right now is, I don't know, $6-7 billion protocol. But if it was $100 billion, I'm not sure what the depth of their strategy, which is essentially like getting the funding rate on centralized exchanges, because there is a certain depth you cannot cross, at least for that. Of course, if there's going to be more trading, then it's going to get even more deep, right? But there's also a possibility that Ethereum means a lot of USDE, and then at one point the trading activity shrinks, so the depth like is smaller, and then the yield would naturally like dry up. Is it a problem? Potentially not, but then also the end consumer should at least somewhat understand the simple mechanism out there.
Yeah. Yeah, I mean that's basically what like Terra Luna was, not to like bring up a coin that exploded, but that was basically a yield-bearing stable coin, right? Like it was wildly successful for a little while. It was like, hey, you get 20% back on dollars. And I mean, I put money in there because it was, I mean, 20% on dollars was great. But I mean, Athena has really, really high yields too, right? Like I'm not even sure what it is today, but I know that they were pushing somewhat around 20% at least for loops for a little while, weren't they? Or even higher.
I think right now it's closer to 4 or 4 and a
Oh, is it
half.
four? Okay.
Because right now, as mentioned, I think right now is a good example where the trading activity went a bit down, or they grew to the size that there has to be a lot of perps trading activity for the funding rate to get a proper yield for all the funds that are deployed. But still, it's decent. I mean, 4% is, I would say, fine. The moment you
Yeah.
start going to 2% low or lower, then it's like, is it worth the effort? Usually,
Yeah.
I see that people have this kind of a mindset. Like, if it's 2% and lower, is it worth the effort? 2 to 4, maybe I will do or not. 4 plus, okay, that's interesting. And then potentially like 6 plus, and then going higher, it starts to get people excited. And as you mentioned, hey, I'm going to raise a hand again as well. I did have exposure to Terra Luna, like Anchor was the name of the product, right? Like it did offer
Yeah.
20%, and
That's
I
correct.
did enjoy. Thankfully, it was a small position because I was skeptical about the sustainability of the protocol back then. But I was like,
Yeah.
hey, everyone else is doing that. So I was like, I don't want to miss out on everything over there, because there was also, as far as I remember, there was also a potential for an airdrop, or there was an airdrop. I don't really remember
Something.
exactly the specifics, but there was 20% yield on dollars, and I did earn it for, let's call it 6 or 7 or 8 months, and I did see it accrue on my account on dashboard, and there was liquidity to exit the position on regular days, right? And then out of the sudden, one day your position is worth almost zero, right? So this is something that people should also understand. If things
Yeah.
go south, is the position discounted, let's call it by 10%, 20%, or 50%, which is acceptable still. Like even 50% probably is acceptable, or it just goes to zero, which is unacceptable. I mean, like going to zero
Yeah,
is very, very painful for the end user because one day you have money and the other day you're like, hey, it's gone, like nothing there.
yeah, yeah. Yeah, that was a wild one. But there was a lot of risk there that it wasn't that not everyone was seeing, right? And I think that what we're seeing now with stable coins, like I think that stable coins, there's like broad acceptance of stable coins. Like I think in the US they're going to pass or like about to pass the Genius Stable Act with stable coins. So there's like a lot going for stable coins right now. Like I feel like there was a lot of push for crypto in general in the beginning of Trump's reign, but it seems like that kind of slowed down a little bit in general. But I feel like Bitcoin and stable coins are like broadly accepted by everybody as like, hey, these are good for everybody. People can use them, lower transaction fees, especially on Solana. So I see that picking up more and more. And it's like, I think, what is it? Bridge was bought by Stripe for like $1 billion or something like that. So I feel like that's like it's always been like the best product on crypto is stable coins. So I think that yes, like put like some sort of yield on top of those, like, and they're incredibly liquid and you'll be able to spend them everywhere. It's like, why would you use your credit card when you could hold money, get, 5, 6% back yield on it, and you can instantly spend any of that? I don't know. It just seems like a way better product and way better shift in mindset and shift in like the way that everything's going to be done, right?
Yeah, definitely. And I believe this is the future that we strive for. And all of that being on the rails that are international, right? Because the
Yeah.
one of the biggest problems of traditional finance systems that I keep repeating is they were created in silos. So the US created itself,
Yeah.
Mexico created one for itself, Poland created one for itself, and so on and so forth. In Europe, we have European Union, right? And we have euro as a currency. But an example, Poland is a part of the European Union, but we have our own currency called zloty, which is not
Yeah.
part of the eurozone. So there are so many, peculiar cases out there, and all of those systems are usually not connected to each other. And there are those systems like Swift or other, let's call them in Web 2 bridges that try to
Yeah.
bridge the gap, but they're just either inefficient or working not like as well as the blockchain technology can. And this is like one
Yeah.
of the promises I believe crypto is going to bring to us, like a globalized financial system for the globalized times. Like everyone knows pizza and everyone knows memes. Everyone should also know how the transactions globally can work seamlessly without waiting days or weeks even for a transaction that is across countries to execute.
Yeah, like if I was to try to send you money from California to Poland, like the traditional rails are miserable, right? It would cost 25, $50. You'd maybe get the money in, I don't even know, a week, maybe even a month. Where I could send you stable coins right now, you get it in I don't know, 3 seconds. And if you want it in a different currency, we could, you exchange that really quick. So, like even like checkout with Stripe, it now has Solana as an offering. Like I see that everywhere, and it's like it's pretty exciting, and it's easier for users to spend, and it's easier to set up to actually like accept payments for them too, right? Like setting up a traditional way to actually take money is definitely really hard. You have to integrate some sort of service where with Solana it could just be like a couple lines of code, right?
Exactly. And then you have this composability. So, you stack and stack new services or products around it and you make it just work better.
Yeah, yeah. That's exciting. I'm excited to hear about that. So let's see, what else do we need to cover about Redstone? We're getting off topic a little bit. So Oracle, it's primarily focused on RWAs. What what else are you guys doing? What any other big RWAs that any of the listeners would be checking out, or what do you got?
Yeah, I encourage everyone to follow Redstone underscore DeFi on Twitter and myself, Marcin Redstone. Both of us try to create like engaging and interesting and educative content. Recently, we created a really good article around private credit, explaining this, railway example and how the looping works in practice with some examples on the Drift Institutional and Camino itself.
Hmm.
As Redstone, we go where builders are. So we are an oracle by builders for builders. 75% of our company are engineers because we believe the product should be extremely as reliable as it possibly can. So we have never had any mispricing event or hiccup or price manipulation or any kind of sort. We've been always like 100% reliable, which for DeFi protocols is extremely, extremely important because that's what protecting the users themselves. Um, and in terms of going forward, we talk with a bunch of institutions. I cannot mention many of them yet because those are usually under NDA that we can break. Um, but specifically on Solana, you should expect some more stablecoin related stuff happening. As you mentioned, it's a great product market fit, and I would say we have even like stablecoin summer right now happening on our before our eyes. I'm pretty excited about Juplant, which is going to be lending protocol from
Oh yeah,
Jupiter. They announced it with cooperation with Fluid, which is the Ethereum-based lending market that, in my opinion, is very interesting. So you have two very different products like Jupiter based on Solana and Fluid based on Ethereum, collaborating to bring like Juplant, the lending product. So I'm pretty excited about that collaboration, and I love to see it in the pretty competitive crypto world. I have a feeling that many people try to compete in crypto, like they rather think how to compete better. Whereas in my view, we are still very early and the pie keeps on growing and we should
yeah,
just think of ways how to grow it even further, right? So instead of, for example, Jupiter launching it themselves, landing on EVM or Fluid, just launching a landing on Jupiter, they join forces and do something together with two strong brands and two strong teams that I'm aware of. So I really
yeah.
love that kind of approaches.
Yeah, yeah, me too. When you speak about like all these different firms that are talking to you, like the level of interest from TradFi is like at an all-time high right now. It's we actually are early, so like the more we can work together, the better products that come out. Competition's good, right? That pushes us to be better, but there's also a collaboration part where it's like we do need to all kind of work together and build out better ecosystem for us all, right?
Yes, exactly. And for any builder willing to check out what Redstone has in-house, you can go to app.redstone.finance. And then in the push model, you can pick Solana and see all the traditional finance tokenized products, but also crypto assets that we deliver over there. And if you have further requests, feel free to reach out to us either on Telegram or our Discord. We usually really like talking with, no, we always like talking to builders, like when they try to innovate and essentially bring something new to the table. We want to be the partner they can ideate with and then bring to production. To give you a tangible example, Itina that we were talking about today, Redstone was the first Oracle to deliver price feeds for USDE and SUSDE back in the days. Many people were telling us, hey, it's going to explode. And we are like, look, it's an experiment. If it's going to explode, let it explode. And then we know we are not going to the right direction. It's
Yeah.
all about being transparent about the risks. And if someone is okay accepting them, then let's go. Let's give it a try, right?
Yeah. Yeah, I love that. I love that. And I'll definitely put a link to your guys' site and maybe to your Telegram as well and Discord in the show notes. So check them out. It seems like what you're building is awesome. I think it's necessary. I think that this is a different type of adoption, like I said, than what we anticipated. But I think that it's amazing, right? I think that everyone can kind of find what they're looking for on Solana. I think that what you're building is really important, really necessary, and really hard too, right? It's not easy to be 100% reliable and not have any like price change incidents, right? There's a lot of adversarial, like tough people out there, right? So love what you guys are doing. I look forward to seeing some more products come out, and I'll definitely check out the sites. Thanks a lot, Marcin. Really appreciate it.
Thanks a lot. It was great to be over here. Looking forward to keep connecting with the Solana builders. And here, maybe I want to also thank Solana Foundation for being supportive as we're expanding in the ecosystem. We got, the technical documents and resources to do the integration. And also when we wanted to connect with the builders, I believe the ecosystem was supportive. So thanks a lot for that and looking forward to keeping expanding on Solana.
Awesome. Sounds good. Keep up the good work. All right, thank you guys so much for tuning in to Solana Weekly. Once again, this is Thomas Bahamas, and I have one final ask for you guys. If you could, please subscribe on whatever player you're listening to. You could leave a review, that would be amazing. If you want to shield me your bags, work for them. But yeah, really appreciate it. And as always, this is not financial advice, but I want you guys to accelerate, move forward, and let's get this bag. I'll catch you guys next week.